So we are recording. Good morning,
Super.
Rinky. How are you?
Good. Excellent. Thank you.
Super, super, super. So today I wanted to go over a couple things with you, and that was some information from the Globus Fund and Globus Financial. So you sent me over some documents yesterday that I'm very, very, very excited about, okay? Because we have referrers who are starting to bring us new clients to the fund. Additionally, one of those referrers asked us for a comparison against real estate funds. So we took the #1 person in the real estate market, Grant Cardone. He's the biggest guy in real estate right now out there, and he's got several funds, a couple $100 million worth of real estate funds to be exact. And you took and analyzed those returns and you compared them to the returns at Globus. So what I'm going to do is I want to share my screen right here, and I want to go over first the Globus fund versus the Cardone fund. That's what I have up now? Is that correct?
That's correct. That's it.
Okay, super. So can you tell me a little bit about this document and what it entails and what it should mean to anybody?
Yes, I sure can. What we're looking at here is to look at what is the opportunity to get a better return for an investment. So the Cardone Real Estate Fund is what I've taken is I think it was 15 different offerings that they put out and that they sold. So I took the average of those 15 and said, okay, what is the return if you make an investment in that fund? What is the return? In other words, it's like any other real estate investment. You buy a piece, or the fund buys buys properties, and then they manage those properties, either renting out apartments, or if it's in the commercial space, it might be restaurants or what have you. So they rent that out and generate an income, and then they take off their operating expenses, and then the person that's participating, the investor, gets a portion of that return that you're generating off of that property. So I took those 15 properties and said, well, let's just take an average just to get a kind of a number, and that is the number here down at the bottom, the blue line. Okay, if you look at this over a 15-year period, and most of the properties are in that range, 15 to 20 years. I think the average maybe is 17. I says, okay, let's take the benefit of the doubt, move it back to about 15 years where that fund then basically is complete. In other words, these are designed so that after a period of time, they turn around and sell those properties, and then you, the investor, would get your money back. But you have to keep it in there, and all you're getting now is basically a monthly or quarterly return out of that fund. So the blue line there shows you, and it's about, if you look at the dollar value, for every million that you invest in those type of funds, you can see on a yearly basis, that's an accumulation of the income you're going to get off of the $1 million. So in 15 years, it's a little over $500,000. And that is basically on the operating cash flow of that fund. And the fund you're kind of committed. There really is really no aftermarket for these funds. You have to wait for the term. But there are situations where you can find people that want to buy your portion of the fund, but it's usually at a significant discount. If you had to liquidate and say you need your money, then you kind of have to find a third party to acquire your portion of the investment in that fund. So there is no real liquid market. There's a market, but you really have to find a buyer, and you're going to get a significant haircut or big discount for you to sell it. So you're really committed in that 15 years. And that's very important to understand that right out of the chute. The second line, the pink line, is the Globus fund. A client, in other words, if you invest in the Globus fund, this is the return over that same period of time. And you can see by year 15, and this is the accumulation of your basically your return out of the Globus fund, you can see it's almost 3 times, 1.5 million in 15 years versus a little over 500,000. So you can see the significant advantage and the opportunity that the Globus fund provides over the real estate fund. And then if you took that return and said, okay, let me reinvest it in a Globus fund, that's the yellow line. Okay, so rather than taking it as income and spending it on something, you could reinvest it. And here we're reinvesting it basically at a 10% fixed rate over that same period of time. So if you kept the money in the Globus funds, and as your investment is throwing off its return, you're reinvesting it at 10%, and you can see after 15 years you have 3.5 million. So you can see the significant opportunity of really getting a much higher return for the same time period and the same commitment. In the real estate fund, you are committed for the 15 years. Your funds are basically tied up, and if you want to get them back, there's a significant penalty. In the Globus fund, you can see if you kept it in that fund at the same time, you have an opportunity to go to 3.5 million. That's almost 7 times over the real estate fund for the same time frame, the same commitment. So there's significant opportunity. In fact, in the Globus fund, you have the option to say, well, let me take half of the return as income, take half of it out each month, and reinvest the other half. So then you'd kind of have a line in between the pink and the yellow line, if you basically only let half of it to be reinvested. But the opportunity is significant for being invested in a Globus fund.
Okay, so if I understand correctly, the bottom line here represents the Cardone fund, and this is a type of fund that you're in it until the end. Basically, they've invested in a property, you're in it until that property is either sold or the deal itself expires, depending on what the exact contract says.
That's correct.
Okay, so that line on the bottom is, and this is probably typical of what something like a REIT or any type of real estate fund would do. I think what Mr. Cardone does is specifically in multifamily residential apartment buildings in the mid-level. So he doesn't invest in the low level, the Section 8, and he doesn't invest in the high level, with high-end stuff. He invests in the middle class, which is more secure if there's an up or down in the economy. So I get it. So basically that is what you can see there. So the second line then is the Globus fund. And that is if you withdraw the monthly return, the monthly income that Globus gives you every month. So if I understand correctly, the Globus fund actually pays you something like a dividend or some portion of the income that's generated on your account on a monthly basis.
That's correct. That's the pink line. So you're taking it out, okay, and you're using it.
Then you put that in your pocket. You can go and buy a Mercedes or a new Rolex or whatever it is you want to go and buy. That's what happens if you take that money out and actually go and use the income.
That's correct.
And so the yellow line is if you actually leave your income in the fund. And that is something that's like compounding. Is that why that number is so much higher?
That's correct. It's really compounding. You're putting it back into the Globus fund, and then therefore it's going to earn, a dividend or a return on what you got. So you're basically value that your investment is increasing based on how much of your income that you put back in the fund.
Wow, that's incredible.
So basically the idea here, what you would end up with 3.5 million plus your original investment, which was $1 million. This is all.
You'd be at about $4.5 million.
Correct.
In the 15 years if you decided to withdraw that all.
Correct.
That's fantastic.
That is.
Comparatively with at the end of 15 years in a real estate fund, your money could still be tied up in that real estate.
Well, or if you have to sell the property and it's depressed, you may get less than your $1 million back. There's,
Okay.
So it's a bit, there may be some appreciation in the property, but 15 years, you think about it, apartment buildings the renovation, sometimes they get old, right? And you get to the point where you have to either, demolish and replace because of their age.
Right.
So they're tied to the value of real estate.
Okay, so in that case, then the Globus fund must be much more risky than the real estate fund, because the real estate fund, which everybody thinks real estate, or everyone says that real estate is really secure, then I'm assuming that the Globus fund would be more risky. Can you talk a little bit about that?
Well, you got to define what is risk. I mean, the Globus fund invests in, I'll call it, company assets, invests in stocks and options. And those have value over time, and they go up and down over time. But in the long run, if you look at the experience in the stock market, that over the long run, the stock market has gone up. It's had its down years, but the strategy that the Globus fund uses, it can still generate an income and a return no matter what happens to the underlying base value, because it's using options in the options market. So it's mining for options, generating a return. And in a 15-year period, there may be times where, sure, the fund has gone down in value. And if you liquidate it, okay, you might get a little bit less, but that's no different than selling the real estate when the real estate market is in the tank, so to say. Real estate goes up and down, and we've had significant, I mean, if you think of the 2008 and 9, real estate bubble, what happened to real estate properties? They got cut in half.
Oh, yeah.
That can happen in the real estate market just like in the stock market. So the risk levels, I would say, are fairly comparable. The only benefit, or the other benefit from the Globus fund, it's fairly liquid. In other words, you can always tomorrow sell stocks in the stock market. You can't necessarily sell real estate tomorrow. You basically have to find a buyer, and if it's depressed, at that point in time, it may be difficult to find a buyer.
Right.
Where in the stock market, the assets and the stocks that the Globus fund invests in are very liquid. They're big companies. There's always a market. So that's not an issue, okay? So you can time your entry or time your exit in a much better fashion in that fund than you could with the real estate fund.
Okay, and real estate, a lot of people say it's not risky, but when you're renting out properties, let's say there's a fire or a mold infestation or a hurricane. We're from Florida, so we've had that happen, God forbid. But there could be any number of things that also put risk on real estate, right? So yes, there is a piece of land there, but in order to make money on a REIT, especially when you're investing in income properties, multifamily residential, you have to have that income. So if there is any hiccup in that income, I mean, it could also affect the value. Am I correct in understanding that?
Both of that, right. I mean, if the property got destroyed or had problems, then you're not generating any rent, but you still have the expenses, right? If you have a mortgage, you have to pay, taxes, you have to pay, interest on mortgages, and you have to pay the upkeep and the repair. You have insurance, but still the property may not be producing income for 6 to 9 months. You can't ever recover that. You can't go say, well, I'm just going to raise the rents. No, you have to be in the market, and you can't, ask for your rent based on what you think it's worth. It's what the competition is renting their real estate for. So you are very, bound to what that real estate market is providing. So, right, there are ups and downs. There are risks in real estate, just like risk in the stock market. I think, though, the opportunity in the stock market is, with time, it has always been demonstrated that markets have gone up and gone down, but in the long run, the stock market has gone up. So if you have 15 years, okay, right, in year 7, you say you had a big dip. Well, that's no different than the real estate market collapsing in 2000. And sure, it's taken 5 years to recover back to that level. Stock market usually recovers a lot quicker. I mean, in 2010, it was back to where it was in 2007. So in that respect, they're kind of they're kind of the same. You just have to take the time. This is where people make the mistake. They say, well, okay, if the real estate property got depressed, you sell it at a loss. Now, when are you going to decide to go back and buy in again? Okay, stock market's the same way. If it goes down and you sell at the bottom, you're sitting waiting. When should I get back in? You're better off staying in the market, holding good assets, and letting those assets with the strategy in the Globus fund using options to generate the monthly income. And that's the key. You've noticed we've been in a period here of high volatility. And the thing that a lot of people don't understand during this period, the last week, the option premiums has more than doubled because of the volatility. So you mine those premiums when the time is right and take advantage of that. You can't do that in the real estate market.
Will always go back up.
Correct. I mean, you own, this is the key. You have to, this is one thing that the Globus Fund does. It uses very, I'll call it intelligent technology, trading technology, to find those companies, okay, that are going to be around, that are not going to get distressed even when the market goes down. They're always going to recover, and they're throwing off, or they are significant players in the options market. Very liquid.
I was going over this with my wife this morning after I first saw it, and she said, and then she actually asked me, Adam, what's the risk? And the way that I saw it with what you'd explained to me about the kind of companies that you invest in, because a lot of times people use the word stocks and ETFs, and it makes people afraid because what is a stock? What is an ETF really? But what you're really investing is in companies. And in some cases, you're investing in commodities like gold or oil or natural gas. So the way that I explained it to her from my understanding with you is that unless you're betting on America failing or business in general failing, like there's some type of, catastrophe, a nuclear explosion or something like that, God forbid, generally, your investments are safe because the stock picks that your technology run picks are actually fundamentally sound companies, so that even if they do go down, they have, like, I asked my wife, so if there was a catastrophe, would you still need AT&T? And she said, yeah, we'd still need AT&T. And I said, if there was a catastrophe, would gold disappear? She said, no, there would still be gold there. And I said, well, what about electricity? Would you still need electricity, or would you still need gas? She said, well, absolutely. We'd still need gas. We still need electricity. So those are the smart types of companies, as I understand it, that you invest in, so that even if there is a dip of some kind, because the markets go up and down all the time, we don't really focus, or you don't really focus on that. You focus more on the income you can generate. And as you said, when there is a dip like that, the income that you generate sometimes 2, 3, 4 times what it normally is. So you make up for any dips on the income, and you just keep mining the income while you're waiting for any type of stock to recover, knowing that those stocks will recover because you've invested in sound, fundamental, long-standing companies that are going to be around to live another day. Do I get that? Am I right in that?
You are absolutely correct. And that is one of the key elements is the fund, or I'll call it the trade technology, does not chase, I'll call it option premium or those high risk opportunities. It goes after solid companies with great fundamentals and uses them. And people say, well, you're leaving money on the table. No, it's risk reward. The calculations involved are very complex to look at the risk reward for every opportunity and make sure that if that is the trade that the system says go ahead and do, it has done its best job, okay, of finding those that are going to reduce the risk and still generate an excellent return. It's really demonstrated on this chart, okay? Right. There are opportunities in the stock market where you could double this chart for that pink or that yellow line, but that's not the goal, because that adds weight, adds additional risk. Okay, we'd rather be more safe.